All right. Good evening, ladies and gentlemen. Welcome to the monthly market review for the month of February. It has been an eventful month. I think it has also been a very eventful 72 hours with the US and Israel jointly launching military strikes on Iran, which in turn has, of course, retaliated across the Middle East. Tensions continue to be high, and we're, of course, all hopeful that a ceasefire is accelerated. However, at this stage, we as investors have to adopt a sort of wait and see approach as we get more information and updates on the situation. In the meantime, let's review how February has been. February proved to be one of the most consequential months for market structure that we've seen in some time, not because of necessarily the magnitude of the moves, but because of what those moves signal about the fundamental reshaping of leadership and investment paradigms. So, a first quick rundown of broad markets. February delivered one of the most pronounced divergences we've seen in years between US equity markets. Nasdaq was down 3.4%, Dow Jones up 0.2%. That 3.6% spread between the Nasdaq and the Dow is the widest monthly divergence that we've seen since the immediate aftermath of the 2022 bear market. Additionally, it's also worth highlighting that the Dow's gain came almost entirely from just 10 stocks, while the Nasdaq's decline was broad-based. I think that sort of tells us that this isn't just random noise, it's a systemic repricing that we're seeing. The dominant narrative throughout the month of Feb was what markets have termed the AI apocalypse theme. The reality, of course, is that it's a bit more nuanced than that. What we're seeing is investors realizing that AI's first order effect is margin compression for labor-intensive businesses before its revenue growth. Software companies that sell seat-based licenses are suddenly facing customers saying, we need half as many seats because AI is doing the work. That's a very different world from 2023's AI will grow the pie for everyone kind of narrative that we saw just a few years ago. Adding fuel to the fire, we had the Supreme Court on February 20th, the decision being annulled of President Trump's emergency tariffs. This has created fresh uncertainty around trade policy, excuse me. Supreme Court tariff ruling matters less for the specific tariffs and more for what it signals about policy stability. If emergency executive actions can be annulled retroactively, it can be an issue for organizations to plan capital allocation with any confidence. So definitely it is introducing significant uncertainty for organizations and companies. On the fixed income front, we did see a 29 bips move in the 10-year to 3.95%, its lowest level since October 2025. This was driven by stagflationary concerns, expectations for continued Fed easing throughout the year, and the flight to quality amidst equity market turbulence. Notably, even a hot inflation report, specifically the PPI, i.e., on the producer side, late in the month, that couldn't reverse the Treasury rally. And finally, on the commodities front, we did see oil gaining some strength amidst a surge on geopolitical premium, having risen further today itself upon the market opening back from the weekend. We also did see gold's eighth consecutive monthly gain, remaining structurally supported by central bank buying, fiscal concerns, and of course, safe haven demand. So, taking a bit of a deeper dive in the equity market, as I mentioned, US indices have moved starkly in different directions, but the real star was the Russell 2000's 5.83% outperformance, which was the strongest surge since early 2025. This Russell outperformance is significant. It's signaling a broadening of market participation beyond the Magnificent Seven, and the mega tech names that were dominating throughout 2025. And so far, these names have been underperforming in 2026. What's more interesting is which small cap sectors or subsectors have been rallying. If you decompose the Russell 2000, you'll find the gains were concentrated in domestic-facing industrials, regional banks that survived the 2023 crisis, and energy services companies as well. The unprofitable biotech and speculative growth kind of companies that make up 30% of the Russell 2000 actually were falling. So effectively what this is showing, it's not necessarily a junk rally, but a quality broadening. We did see some weakness in some of the mega tech names, especially in terms of adverse reactions post earnings. Despite the earnings beating expectations, Nvidia reported quarter four revenues of 68 billion and guided to 78 billion for quarter one this year. Yet the stock whipsawed all over the place as broader AI caution weighed on broad sentiment. Late in the month, private credit contagion fears also emerged, hitting financials quite hard. Goldman Sachs tumbled 7.5% on the final day of the month, and the financials ETF, the broad ETF, was down 1.13% alone on the final day of trading. Moving on to other regions, the Stock 600 did have quite a strong month, up more than 3.8%. Europe's outperformance is particularly notable when you consider the composition. It's not being driven by the traditional luxury goods or tourism. It's being driven by industrials, reinsurance, and capital goods as well. These are cyclical, value-oriented sectors benefiting from nearshoring, defense spending, and manufacturing capex. Europe is getting quite a big bid as a real economy play, while the US is being punished for being too tech heavy. Similarly, Japan's story is fascinating because it's the reverse of the last 30 years that we've seen. The yen weakness is now effectively good for domestic Japanese investors because it inflates the value of overseas earnings. Japanese corporates generate anywhere from 50 to 60% of profits from abroad, from overseas. And yen trading at 153 or lower as we speak, 157 today, means that these profits translate into record yen earnings. This is why Japanese equities can rally even as the BOJ hints at potential rate hikes. It's showing that the currency matters more than the rate, and they did so strongly in the month of Feb. Chinese markets, though we did see fewer trading days in the month of February due to the Chinese New Year, they did take it on the chin, as we can see, with the Hang Seng Tech down more than 10%. It's a combination of uncertainty in terms of tariffs. Of course, the favorable situation for China only recently became cleared up, as well as the anticipation of the two sessions of parliamentary meetings that are scheduled for this week. Investors will be looking out for the provision of guidance on policy as it begins on the 4th of March and lasts for a week. So let's see what the outcome is from those sessions. Moving on to fixed income, we did see yields across maturities dip. Let me also highlight the duration difference. The 10-year dropped to 3.95%, which is significant, but the 30-year dropping to 4.62% is also worth highlighting in particular. We may be able to attribute this to further institutional investors, the likes of your pension funds, insurance companies, sovereign wealth funds, massively extending duration as we speak. They're locking in those 4.55% yields for 20 to 30 years because they believe that this is as good as it potentially might get in the next 10 years or so. What's also notable here is that even a hot inflation report in late in Feb, which would typically pressure treasuries, failed to reverse this trend. That tells you just how powerful the safe haven demand was. Investors were willing to overlook near-term inflation prints in favor of protecting capital amidst some of the AI anxiety that we're seeing in markets, the geopolitical risks, and of course the stagflationary concerns. On investment grade credit, investment grade bonds did hold up quite well as well. Spreads do continue to remain quite tight at roughly 80 bips over treasuries, and IG yields also are outperforming high yield when you compare it to high yield in terms of risk-adjusted terms. We do see this as consistent with sort of risk-off mentality that we've been seeing in recent times, where investors have been favoring quality. In terms of the JGB world, yields remain elevated as the BOJ did signal potential rate hikes further, keeping the JGB curve quite steep. European AT1 banks did come under some pressure later in the month due to the private credit fears and the AI disruption story that we're continuing to see. However, broad AT1 spreads did remain quite contained as ECB guidance still continues to be supportive. Moving on to some of the other asset classes, we did see that gold continues to maintain strength in the month of February, despite being 2.6% from its all-time highs. One reason for the momentum continuing is ETF inflows didn't stop in the month of February. Physical ETF holdings have actually increased in this month, even as prices have fluctuated. That means that the pullback was entirely futures and leverage positioning being unwound. The underlying structural bid for gold, central bank buying, Asian households purchases, and institutional diversification have all contributed to the gold's sustenance and strength. In terms of the US dollar, Trump's comments about being comfortable with a softer dollar, many analysts did dismiss it as just talk, but I think there are some elements in that statement as to why it should be considered seriously. The administration has explicitly linked dollar strength to manufacturing competitiveness. If you're trying to onshore manufacturing and narrow the trade deficit, you need a weaker dollar. The policy intent is quite clear here, and the FX markets are taking that quite seriously. Hence, a weaker dollar can't necessarily be taken just as noise. I think it's policy working as intended. Finally, Bitcoin did see its third worst month since 2013, with crypto's broad 15 to 20% decline getting framed again in terms of as AI anxiety. But it's worth also considering that crypto for 2026 was being priced for Fed easing, fiscal expansion, and liquidity growth. What we're instead getting is stagflation fears, fiscal uncertainty, and capital preservation. The fact that Bitcoin is down 50% from its October highs, while the S&P is not that far from its all-time highs, also is worth highlighting. And of course, it's not just Bitcoin. The likes of Ethereum, which is down nearly 20%, is also particularly telling of where the crypto space is. Just briefly touching on the fear and greed index, it sits in the fear territory as we speak. If you look at the components, which we will do in the next slide, most of them are sentiment driven, not necessarily fundamental focused. Put call ratios continue to be elevated. Earnings haven't collapsed. VIX continues to be elevated, but corporate credit isn't blowing out at this point. So this is the fear of what might potentially happen, not necessarily the fear of what is happening at this stage. So, if we're to look at some of the more specific components of the fear and greed index, we can see that stock price momentum and the breadth are both negative in terms of contributing to the fear and greed being in the fear side. It's concerning because it tells you that the weakness isn't isolated to the mega cap tech. It is spreading potentially in the future. When breadth does deteriorate, it usually takes some time to reverse, even if capitalists appear, because positioning needs to be rebuilt. And it'll be interesting if over the next few weeks or so, we do delve into that extreme fear segment. Right now, we're in that sort of nervous, but not necessarily panicking segment, which can persist for weeks or even months at times. The other thing worth noting as well, that this index specifically is US centric without any exposure to Europe and Asia. Global investors have been rotating away from the expensive, fearful US markets into the cheaper, less crowded international markets. So moving on from the weekly data, I want to take our attention towards understanding a little bit about the AI disruption's impact on global markets, taking a bit of a top-down approach, starting out with the macro impact. Concerns have been raised about AI's impact on the job market and of course, the overall economy. Several major companies have announced AI-driven job cuts in recent months. Amazon cut 30,000 jobs, Accenture eliminated 11,000 roles, Salesforce cut 5,000 in just last week, Block slashed 40% of its workforce. These are significant real layoffs explicitly attributed to AI-driven efficiency gains and automation. However, and this is where I think this chart becomes quite important, some analysts do disagree with the view that AI will lead to permanent job losses or economic contraction. History has shown that over the last 80 years or so, technological progress has led to job displacement in certain sectors, but it has also created new, different job opportunities, ultimately leading to increased productivity, growth, consumption, and competitiveness. To put it into perspective, the World Economic Forum projects 78 million new roles globally by 2030, driven by AI adoption. Similarly, AI, machine learning, and data science role hires are up 163% year on year. This chart on that slide, I think, shows this dynamic quite clearly, that automation and technology have consistently driven structural shifts in employment, but total employment has grown over time. The key insight is that jobs don't necessarily disappear, they transform. Therefore, as investors, I think it's important that we need to position for both the near-term pain and the long-term gain. That means underweighting the AI displaced segments for now, even if they ultimately recover, and it means overweighting the AI enabled segments, even if they're not necessarily the household names today. So if we're going a bit deeper and maybe one or two levels down from the macro, we've seen the short-term pain already quite evidently on the subsector level, as this chart shows. Software has gone down significantly in comparison to the semiconductor space and the broad S&P. It has gone from 12% of the S&P 500 weight to 8%. That's a $1.5 trillion evaporation in market cap in a sector where revenue is still growing 15 to 20% on an annual basis. Revenues are growing, but valuations are collapsing. That's a pure multiple compression driven by AI disruption fears. In terms of understanding how AI has been hurting software companies specifically, there are some specific elements. Most SaaS companies, for example, charge per seat. And if AI agents can do the work of 3 human seats, demand for seats naturally falls by 66%. Similarly, software companies generate anywhere from 20 to 30% of revenue from implementation, customization, and support services, which can all be streamlined and effectively replaced by AI. Additionally, AI, of course, makes software easier to build and deploy, reducing barriers to entry for any competitors. The results, the likes of Intuit, down 35%, Adobe down 21%, Salesforce down 23%, Oracle down 25%. All of these are figures just for this year. Now, semiconductors don't necessarily face any of these issues. Demand for compute is insatiable. Every incremental AI model, every incremental inference request requires chips. TSMC's order backlog, just to put into perspective, is 18 months out. NVIDIA's H100 chips have 6 month delivery times. So clearly, supply is the constraint, not necessarily demand. And that's a completely different margin dynamic that investors have to consider. I think here's also where the nuance the market is trying to figure out. Not all software is necessarily equally vulnerable. Infrastructure software, the likes of databases, cloud platforms, cybersecurity, definitely are more defensible because they're embedded, mission critical, and high switching costs. Application software, however, is more vulnerable because it's user facing and may also be easier to replace. So therefore, I think the selective recovery narrative is right, but the market hasn't differentiated it yet. Right now, all software across the board has been sold off indiscriminately. However, most analysts do continue to believe that we are far from the death of software. Software companies that continue to embed AI into their products, reduce their own cost basis of using AI, and provide differentiated value will survive and potentially may even thrive. That creates opportunity for active managers to pick the winners in the current stage of the market, which takes me quite nicely onto where we can potentially look at to participate in potential winners. I think when we're taking a portfolio approach, diversification, of course, has to be at the crux of it. Worth highlighting, of course, that when we're considering any of these themes, you have to take a longer term, multi-year perspective on the fundamental growth perspectives rather than considering market timing specifically or technicals. I won't list examples of all these themes, but I'll name a couple for you to get an idea. So I think one of the first important aspects is to own the full AI value chain. Rather than concentrating exposure in a handful of mega cap tech names, diversify across the broad ecosystem. This means owning compute infrastructure, the likes of semiconductor companies like NVIDIA, TSMC that provide the chips, and also own cloud providers, platforms like Microsoft's Azure, Amazon's AWS, Google Cloud. These all host and distribute AI models. And then, of course, you have the segment which has been challenged the most in recent times. You have the enterprise software, companies like Salesforce, ServiceNow, Palantir, that embed AI tools into core business workflows. They are going through a rough patch, as I mentioned, but long term, they do stand to gain. As such, by owning that full stack, the full segment, you reduce single point of failure risk and capture value across multiple layers. When you're going on to non-tech segments, valuations also become quite attractive. Industrials trade at a multiple of 18x forward earnings. Tech, the broad tech industry, trades at 28x. So if AI drives comparable productivity gains in industrials versus the technology space, industrials are effectively 35% cheaper for the same level of growth. Specific examples, if you were to take the likes of ABB, Rockwell Automation, both are embedding AI into factory automation and predictive maintenance. In the healthcare space, something like an Intuitive Surgical is integrating AI into robotic surgery, and the adoption curve of AI is accelerating. In terms of the point number three, international diversification, I think this is one of the most underappreciated opportunities. TSMC, as I mentioned, is trading quite attractively, 16x forward earnings. Samsung trades at 12x. Compare that to NVIDIA's 35x. You're getting equivalent or arguably better AI exposure at half the valuation. Of course, the consideration is that it is geopolitical and currency risk have to be factored into these. But if you're a long-term investor taking that sort of 5, even 10-year horizon, these risks can be managed. I think Japan is also doubly interesting. Given the state of their aging and slowing economy, they have to automate. If not, their GDP will come under significant pressure. Names like Fanuc or Keyence have captive domestic market plus potential global upside. So it definitely is quite an attractive sort of geography to be in. And then finally, I think specialist managers, this is, I think, where you can get a little bit more tactical. If you believe in the AI theme, but don't necessarily have the conviction on specific names, dedicated AI infrastructure funds or thematic ETFs can provide broad exposure. But worth highlighting that you have to be quite careful when you're exposing your portfolio to these kind of strategies. Most AI ETFs are just tech ETFs with 60% in the Magnificent Seven. Look for funds that are truly diversified across the value chain, in terms of the compute infrastructure, cloud, and enterprise. Alternatively, we have also seen the success of alternative or hedge funds as they used to be traditionally called, the likes of the long short strategies, long short tech strategies. We've seen doing phenomenally well in recent times. Funds that are able to short the disrupted, the likes of legacy software, legacy retail, while going long the disruptors, AI infrastructure, automation, and so on. So to summarize, the key insight, I think, from these three slides, there are multiple ways to win in the AI game beyond just owning NVIDIA or Microsoft, with diversification has to be the main aim of the game. So moving on to more current news and some updates, and of course, immediate implications for markets based on the recent developments that we've been seeing across the Middle East, the intense military escalation in Iran, and of course, the fresh updates that we've been seeing today of the exchanged fire across Lebanon. The specific catalyst, I think, for this also was President Trump's State of the Union address, where he explicitly said that all options are on the table when it comes to Iran. That language is typically reserved for imminent military action. It is scary. And of course, there were some intelligence reports suggesting that US is positioning themselves in terms of assets in the region. And that, of course, did lead to the spike in oil of 8% in just a single day. So a broad de-risking mentality is to be expected, and it is likely to persist over the next few days as investors take stock of the situation. We can expect continued positive reactions in safe haven assets, and traditional risk-off assets, of course, like the gold, US dollar, treasuries, and of course, oil. The duration and prospective resolution of the conflict, that will determine the market direction that we see. If we do see further escalation, expect renewed volatility and, of course, a flight to quality. If we see de-escalation, risk assets could see a bit of a relief rally. Our views have been outlined in a commentary, which was shared earlier today, or which will be shared later today. So please feel free to reach out to us should you not get a chance to read it. In terms of tariffs, Supreme Court ruling did create a legal precedent that emergency executive actions on trade can potentially be challenged and even reversed. That matters because Trump has threatened 10 to 15% tariffs on multiple countries as retaliation. If these can be challenged and reversed, it limits the administration's ability to use tariffs as a tool, and particularly in terms of negotiation, which would be good for the likes of industrials, materials, and foreign exporters, for example, European exporters. The corporate lawsuits, the likes of FedEx and Nike, are seeking 50 to $100 billion in refunds collectively. If they win, that's a direct capital injection to corporate balance sheets. It's not enough to move global markets, but it is a marginal positive for capex and buybacks for these specific names. I think the broader implication is that policy volatility is definitely at multi-decade highs, probably since the 1970s. For investors, this does mean that you may want to position more defensively, favoring quality over speculation and being prepared for continued volatility in the near term. So just moving on to this week's highlights, I think most important this week will be Friday's employment report. Consensus is expecting 170,000 non-farm payroll addition, unemployment at roughly 4%, and wage growth at 3.8% year on year. If we do see a miss on payrolls, it will trigger a broad risk-off move. It may validate the short-term narrative of AI destroying jobs faster than the economy can create them, and as such, that might lead to a risk-off mentality. So do look out for that report on Friday. Additionally, Wednesday, we do have the ISM Services PMI figures. These will be heavily scrutinized, services being 70% of the US economy, and the previous reading being at 53. It's barely in expansionary. If it does, for whatever reason, drop below 50, i.e. contraction, recession woes will start brewing again. Manufacturing PMI is already borderline, so if services also roll over, the recession narrative accelerates even further. In terms of the earnings, Wednesday, we do have Broadcom's report critical for the AI narrative. Broadcom, of course, is a pure play AI infrastructure company. AI chip revenue has been growing at 70%, but if the guidance does disappoint like it did last quarter, the entire AI infrastructure complex could very well sell off anywhere from 10 to 15%. Conversely, if the guidance is strong, it could stabilize the sector amidst the volatility that we've been seeing. Target, Best Buy, and Costco's earnings reports will also be announced this week. Give us a clear indication of the average American retailer consumer and how broadly consumer staples as a sector has been doing. And finally, CrowdStrike, I think, is one stock which I'm looking out for. Cybersecurity spending is typically recession resistant. So if CrowdStrike guidance goes down, it tells you that enterprise IT budgets may potentially be throughout facing real pressure. Before we close, just as a summary, I think February was defined by rotation away from the likes of the mega cap tech towards value, cyclical, small caps, and international markets. This broadening is definitely healthy, but requires active management for portfolios. AI disruption is definitely the dominant theme of reshaping markets, but it's creating risks as well as opportunities at the same time. Looking ahead, geopolitical risks, tariff uncertainty, and the AI narrative will continue to drive volatility. And in terms of specific reports to look out for, the employment report on Friday will be quite critical. With that, I would like to conclude the monthly market review. Thank you for your time. And as always, please feel free to reach out to any of us should you have any questions, and we'll continue to update you as the situation evolves. Thank you.